Thank you very much, and thank you for attending another session of RM Smart Investing. Today, I decided going back to the fundamentals, and the reason I want to emphasize that in the past I've mentioned, and I think uh, this year and coming years, we will have some normalcy and get back to basics. And I believe when you have easy money and flood of money, when the government and the Fed, the central banks, they flood the money, sometimes the common sense goes out. And I think this is a good time for really understanding the markets. And I think that's going to pay off, not just for this year, I think for coming years. One of the things about fundamental analysis is that, which is, I think, not only the retail investors are at fault, but I believe a lot of professionals and hedge fund managers, we have accustomed to really shortcuts. We all love the charts, but it's amazing when you want to buy a house, whether to live in or like a rental or investment property. We bring all kinds of experts. We check everything. We want to make sure there's no termites. There's the plumbing is good. Even when we buy a used car, we bring our mechanic. But when it comes to investing, big investments in stocks, especially more of an investments, I'm not talking about day trading. I'm not talking about short-term trading. I'm talking about actually investing. Majority of us, we look at the tips. We want to, of course, we look at sometimes the charts on the short run. We want to see, well, is there an excuse to get into this? And we don't do all the work we need to do. And I think it is important that we have to really educate ourselves and understand the main reason actually we're investing in, what companies or what themes or what asset classes we want to get in. And really, we have to do the work. So today I'm going back into the fundamentals. And today's topic is stock buyback. And basically that the first impression is, oh, it's a good news, when the company buys the stock back, that must be good. But I want to dive in deeper. We want to understand actually what is stock buyback, how it is, what are the reasons actually the companies do buy them, what are the methods. We look at some legality, or we'll look at some examples, and whether are there any ETFs we can use this strategy, this philosophy, and take advantage of it. So first of all, what is a stock buyback? And stock buyback, you probably heard it's a share buybacks or the share repurchase. It's a reacquisition by a company of, they buying their own shares. So it is a flexible way of using their cash. So when the company, has the earnings, has the profits, they usually either they put it back in the company, and that's what the growth companies do, or if they're a little more mature, they decide to share their profits with the shareholders, and they paid in a form of dividends. Another way they can use their cash, and if they feel that their company is a good value, they will actually buy their stocks or the shares. And that's how actually shareholders actually benefit from that. So what happens is, again, depending on the timing of this and depending on the strategy, it probably will increase their times and the share prices. And we will look at the mechanics when we talk about it. In most countries, a corporation can repurchase its own stock by distributing cash to existing shareholders in exchange for a fraction of the company's outstanding equity. And again, we talk about how the mechanics works. So basically, by buying those shares, they're reducing their shares outstanding. And again, we will talk about what happens when they purchase those shares. Either they will retire those shares, and what that means is now you have a reduced number of shares out there, which is opposite of dilution when you have more shares out there, or they put it in their treasury stocks, and the treasury stocks is available in the future for the reinsurance, for the bonuses, and I think they can use that. So it's not floating, but it's there, part of um, their the stocks. So basically, we will emphasize more on when they retire as far as they're buying their shares. So why would anyone or the companies will have the stock buyback? The number one is it's more of a maybe psychological thing, or they've actually, maybe they feel that the stock is undervalued, so it's a good time to get in, and that's what signals the markets. Oh, that company feels, if they are inside the company and they know what's going on, they think it's undervalued, so maybe this is a good time to actually invest in this company. The other thing, the number two, is to distribute capital to shareholders with a high degree of flexibility in the amount and time. And what we mean by that, when you, again, the primary things, usually they distribute it through the dividends. When you are committed to that dividend payment, then you're really cannot be flexible. You have exact dates, you have like the ex-dividends, the shareholders expect that. And when you deviate from that, then the markets react negatively. So that's why when we're talking about dividend payment, you do have a rigid kind of a schedule. But when you do buybacks, with the buybacks, you are flexible. You don't have to do all at once. You don't even have to buy the whole thing. You don't even have to do it. You just announce it, and you don't need the shareholders' vote. The management decides that. They feel that's the best way of using cash. The other thing is, there are companies that maybe they're growth oriented, and they feel if we pay dividends, that the market would think that we are now more mature. So by buying the shares back, they still would put that the face or the front of a growth company. The third thing is that to take advantage of tax benefits. And as you know, when you receive dividends, and this is, of course, there's a double taxation because the company pays taxes when, on the net income, their profits. But when they pay the dividends, so do the shareholders. So the shareholders receive tax, they receive the dividends, but they also have to pay taxes on those. So there are times that when you actually do use the buybacks, although the retail investor or the shareholders do not receive the dividends, but generally there is appreciation in the stock due to, again, the perception, but also we will talk about the mechanics of it, how the company looks more attractive based on valuation. So basically, all of a sudden, your dividend ordinary income becomes capital gains. And, capital gains versus long-term capital gains, they have, most of the time, depending on tax bracket, have more favorable tax treatment. So that would be another reason. The fourth one is to absorb the increases in the number of shares outstanding due to the exercise of stock options. And what we mean by that, there are companies who offer the stock bonuses and then a part of their package, perhaps, and these bonuses can be getting, these stock options can be exercised. So when they're exercised, now you have dilution, you have more shares outstanding or in the floating. So basically what they like to do, if there's a lot of those, this is one way of reducing that increase and that dilution. The fifth one is to use as a hostile takeover defense. And what we mean by that is by buying back their shares, they fend off some of, let's say, if somebody wants to be a majority shareholder, they will reduce that and they will buy the shares back. So that's another way of defending the company, in a sense, by buying more of their own shares. So now that we know the reasons generally why it is happening, how do they do that? I mean, it's not just your props, there's not one way. So we have 4 different ways that the companies will actually buy their stocks back. One, and the easiest way to understand, is the open market stock buyback. The second one is the fixed price tender offer. Then we have a Dutch auction tender offer, and then we have direct negotiation. So let's dive in and evaluate each method. So the first one, and again, the easiest one to understand, and most of the time that's what we are familiar with, is the open market stock buyback. And what that is the company actually buys its shares directly from the market. So they go through their own company's brokers, and the buyback of shares generally happen over the long period of time. And of course, they cannot do all at once because they will move the markets if that's the case. And also, this mention about flexibility, this gives them the flexibility. As I said, they don't even have to buy all the shares that they announce, and they can use the timing of it. At the same time, with the open market, again, they don't have the obligation, any legal obligation, to complete the buyback program, and that's that flexibility. So this is something you want to pay attention, that unfortunately, again, that goes back to the fundamental, and really dive into the company's books, and just not take everything in the face value. Just because a company announces they're going to have a buyback, that doesn't mean they're going to do it or complete it. So pay attention to that. So again, as I mentioned, there's that flexibility. They can cancel their buyback program at any time. There is no voters. So the primary advantage of this open market stock buyback is it's because companies buying back its own shares and has the flexibility of current market price, it doesn't need to pay a premium, and that's the flexibility again. When we come, the second one is the fixed price tender offer. Now, this one, the company actually goes to the shareholders and offers them at a fixed date at a fixed price. And they contact the shareholders. They say, we'd like to purchase the shares back. And the tender offer should be a premium relative to the current share price. So, and then the shareholders who are interested in selling, they said, well, this is a good time, perhaps with a little premium. I think we will go ahead and accept that tender offer, and they submit the number of shares that they want to sell to the company. And generally, a fixed price tender offer can allow completing a stock buyback within a short period of time because they have that date. So this is another way they can do. The third one is a Dutch auction tender offer. And in this situation, it's not a set amount. So basically, company comes out with the offer to the shareholders, but what they do, they put a range of possible prices with a minimum price, which usually it should be above the current market price. And then think of an eBay, for instance. Think about when you do an auction, the shareholders start making their bids, but saying that how many shares they want to do and what is the minimum price they are willing to accept. And then the company reviews the bids that they received, and then they start looking at the suitable price within previously specified price range to complete the buyback program. So the main advantage of the Dutch auction is that it allows a company to identify the buyback price directly from shareholders. So now they're negotiating. So additionally, using such a method, the stock buyback program can be completed within, again, relatively short time frame. So remember, in open market, you have a long range, more flexibility here. If you want to do it quickly, this is another way of doing it. The fourth one is now they don't really want to go to all the shareholders. They want to go directly to one or several large shareholders, and that's called direct negotiation. So they want to buy back the company shares from them. In that case, they come up with, again, there has to be a premium because there should be an incentive for the shareholders to sell their shares. And in that case, they can actually negotiate the buyback price with the shareholders. Now, because of that, because there are not so many of them, it is pretty cost effective in that sense, especially if there are like a few large shareholders. The problem is with the direct negotiation with the shareholders, that could be very time consuming, like any other negotiations, especially if they are savvy shareholders. So these are the four main ones. There are actually six, but these are the four main ones that it is used. So it's like, I think most people just think of, oh, the company goes and buys it back on the open market. So let's see, how does that affect the buyback affects the numbers, and why it looks more attractive when there is a buyback, and why the markets actually react positively. So let's take a look at this example. We have an ABC Corp company at current price is $32. This company pays a dividend, which is $1. So 1 divided by 32 is 3.13% dividend yield. They have 10 million outstanding shares. So 10 million times 32, their market cap is at 320 million. So this past earnings, they received they have made $30 million in net income. So what has happened as far as the 30 million, when you divide 30 million by 10 million shares outstanding, your earning per share is at $3, which means if I divide 3 by $32 current share price, my earning per share divided by share price, my PE ratio, or price earning ratio, will be at 10.67. Now, remember, we are paying $1 of dividends, so $1 divided by $3, which is that net income or earning per share, that represents that my payout ratio, that my dividend payout, is 1/3 or 33%. So let's assume that we think that this is the $32 an attractive price on the ABC company management, and we decide to go and take half of their net income, that 30 million, and use that $15 million, buy our shares at this time, let's say $32. So what that means is, if I divide that, then I have about 468,750 shares. And let's say I retire those. And because of that, now we don't have 10 million shares floating or outstanding in that case. Now we have $9,531,250. So what happens to our numbers? What happens to our financials? And look at the net income, you look at the ratios. So in this situation, we still made that 30 million, but basically our net income earning per share initially was $3 per share because we had 10 million outstanding. But now, if we have 30 million, we have to divide it by 9,531,250. So our earning per share, without doing anything else, again, our income is the same, the price of the stock is the same. We basically increased our earning per share by 4.92% or 15 cents. Now, our PE ratio also will change, because now, instead of $3 in earning per share, we have $3.15. So now my PE has gone down. So I'm at 10.17. The other thing is, now in the dividend payout, $1 rather than $1 divided by, in this situation, by 3, $1 is divided by 3.15. So that's dividend payout is also less, 31.77%. So in reality, but not doing anything, when we look at the valuation and we look at the analysis, we see that all of a sudden the PE ratio has come down, the earning per share has gone up, the dividend payout ratio has come down. So basically, in that situation, we have really improved our numbers. And when we do the financials, the market might look at this more favorably, just because we have reduced the number of the shares. So by doing that, who benefits? I mean, on the surface, we just did that, and it has worked before. It looks like the shareholders will have a more benefit, because the market will look at this more favorably, and they, by doing so also, it affects a lot of other things, such as the return on equity immediately jumps up, return on assets. And when we talk about return on equity, that means your net income divided by your equity, and return on asset is net income divided by assets. So they really shoot up. So basically they look much better. So the company basically got their financials and the ratios that have become more attractive. By being more attractive, analysts following it, then they go and put a better valuation on it. So consequently, the prices of the share prices generally go up. So that's why sometimes when the company is actually and just announcing their buyback, the company reacts favorably. But the question we have to ask is, what is the company's reason? Now, we as investors, we like to buy low and sell high. Is that company's real reason? Now, sometimes it is, and they like to do that because they feel that it is the best use of their cash. So they rather do that because they think they're undervalued. But there are also other reasons. And one of the other reasons is, remember, the management decides this. And management, there are bonuses paid at the end of the year based on improvement of the earnings per share. So what they look at is, well, this could be a quickest way to actually improve our earning per share, improve our ratios. So by doing so, they actually end up getting their bonuses. So you really have to you have to dig deeper, look at their cash flow, look at what is, you have to do some analysis and look at their compensation plans to see what was the main reason for doing so. And that's why it's important to know who benefits from this. So as I mentioned, it is not as simple as it's just because the company did go and decided to buy back their shares. That's the reason that they did, because they felt it was really undervalued. As you shall see in some of the examples, there are times that whether it's NVIDIA or Apple or Microsoft, they've actually bought their shares in the highs. So they've used the buyback. So now really have to pay attention to that. These are some examples of, well, actually, this is the chart of going back to 23 years, going from 1999 on a quarterly basis. I want you to pay attention to the quarterly. These are the timing of these buybacks. So you see, for instance, this is the fourth quarter. The red line is the fourth quarter, and this is as of the quarter 3 of 2022. This is the latest one I could find, and there was $981 billion was actually spent on the dividend on the buybacks. And basically, one thing you will notice, and you look at 2007, for instance, that was the high of the buybacks. In 2019-18, there was a high, and then in the first quarter of 2022, so it was the highest. So sometimes what you look at, there's two observations I will make. Number one is, when these highs of these buybacks, generally that's the height of the markets. So that's kind of a warning sign. And again, do they have a lot of money? You have to remember, we're looking at from 2009 till last year, we had these zero interest or very low interest rates. So the companies were getting all this money at a very low interest, and they had a lot of money, lots of cash. So as I said, going forward, things are going to be a little different, because now that the interest will be higher, and it will be a little more difficult to come by. So that's why we see that how high it was, and generally they could be turning points. The other thing you will notice is the volatility of, we go to high in 2007 and then 2009 and then 2011, and you see there is no, when you look at the red line, which is the cumulative, there is a lot of volatility. Now, if I compare that, this is where the dividend payments are. Then dividend payments for you can see the consistency, the quarterly sum was at 562 billion, but it is pretty consistent. So that's why I mentioned about the flexibility. The company really, once they actually committed, they really have to stick by it. The only drop you can see wasn't obviously the financial crisis from the 2008, and then we went all the way to beginning of 2010 and things turned around. But you see the smoothness of the ride compared to the buybacks. And I want to show all three. So, the companies have paid out $1.5 trillion in over all these years, as far as on annualized basis. And we look at the 2022, so $1.5 trillion, which is a combination of 981 billion in buybacks and 562 billion in dividends. This is just a little sample to see what sectors of the S&P 500 they use the quarterly buybacks, and again we can see the comparison, the volatility, whether there's a consistency. There were times like you see that the real estate didn't have any because of the situation it was in, and then we had started. Utilities do not do it because they are very interest sensitive, but you see a lot of when we think about as far as the in this case industrial or information technology, you see quite a bit in that. So financials, the Fed came out with that they have to be very careful. There's a lot of tests, because there was, again, we talk about it could be manipulation going on. So they have been very careful with the financials. So far, I mean, it does sound good because it does help the earnings, and there's a lot of positiveness. As I said, we want to look at the intention of the companies to see why they're doing it, and if they feel it's undervalued, then it is a good time to go in. One thing happened last year was we had in August, we had the Inflation Reduction Act. And there was part of that act, there was an excise tax on the stock buybacks. And again, this happened on August 16, 2022. President Biden signed the Inflation Reduction Act of 2022. So what does that mean? That means there's going to be a new excise tax on public company stock buybacks. And what that means is a non-deductible 1% excise tax on the fair market value of the stock of a covered corporation, which is purchased in that given year. Now, this happens, it will go in effect, which has already gone, is the excise tax will apply to the repurchase of stocks that occur after December 31st, 2022. And currently does not provide for any relief to taxpayers who pre-authorized stock repurchases or issued mandatory redeemable preferred stock prior to the passage of the act. So it applies to all covered companies, and it is important to understand would that affect. In some ways it will affect the companies. Of course, if the company feels the stock is undervalued, they're willing to take this. Also, you have to pay attention that there's exceptions to this rule. Those exceptions are if the total value of the repurchased stock is does not exceed $1 million. So this applies so much, small companies. I mean, large companies, we're talking about billions. Also is the rule part of the section 368 that There's no gain or loss is recognized by the shareholders by reason of the reorganization. It's the exception will be, again, exemption for the employer-sponsored retirement plan or other similar stock compensation plan. So there's few, again, exemptions, and if it's taxed as dividends, and also if it's part of the real estate investment trust. So these are the exemptions, and also its application to the non-US corporations. So although it is levied on domestic corporation, it will also apply when a US specified affiliate of a public traded non-US corporation repurchases stock of its foreign parent corporation. The tax is imposed upon the specified affiliate as if it were a US corporation. So, and again, when we talk about a specified affiliate, that is entity that is more than 50% owned directly or indirectly by the corporation. Another legal thing I want to understand is something called accelerated share repurchase. And it's not legal. This is another method or another way that the corporation can repurchase their own stock. So when you think of this ASR, just think about forward contracts. We think about futures contract. And so what it does is, again, this publicly traded company wants to buy back a large block of its outstanding shares. But what they do, they use an investment bank to facilitate the deal. So company, what they do, they believe that because their shares are really undervalued, they're in a rush. They don't want the markets go up. So they really want to get those as soon as possible. So, and as we spoke before, by doing so, then the earning per share looks better, which is in circulation. And also by using the investment banker, again, this is like a forward contract. They give them the shares, and then the company holds, they give the cash, like forward looking, and the company gives them the shares back. The investment bank it helps the company quickly consolidate its ownership, making it easier for the company to decide on key strategic moves. So how does that work? This is how it does is, let's say a company wishes to quickly, again, reduce the outstanding shares floating around in open market. So if they did the traditional route that we talked about, usually periodically executing this direct share backs, the price that they have to pay per share would vary. We talked about, again, the flexibility, which is good, but also could be bad because they will miss that window of opportunity. So also it takes time. We talked about that. You cannot affect the market, by purchasing, a big portion of your shares. Although there's a limitation of you can never go over 25%. According to the Securities and Exchange Commission, if the company makes a tender offer, for instance, to its shareholders to buy back shares, they have to keep the offer open for at least 20 business days after it begins. Again, it's the matter of time. But if the company instead relied on accelerated share repurchase program to gobble up a bundle of stocks all at once by purchasing those shares from an investment bank intermediary, the company and the bank could dictate the terms in a way that mutually benefit both parties. So again, this method reduces some of the pricing uncertainty for the company while allowing the bank to pocket a handsome fees because they get paid. So again, I want to think about the forward contracts and again, futures. So you're buying, you're getting at a certain price in the future, but the shares are already going to be under, there will be repurchased under your name. So let's, toward the end, we look at some examples. One of the ways you can find out that, you think this is a good idea, you think the market will react positively, you can go, one of the sites is marketbeat.com, and you can look at their stock buybacks. For instance, this is for the 2023 stock buyback announcements, and like Skyworks, for instance, just came on February 6th, and they announced that they will have in open market $2 billion of buyback amount. Before that was and Semi, for instance, what, 3 billion. So you can look at, or UPS has a 5 billion on January 31st. So these are all announced, and you can, if you feel there's some of them are, you've been doing your own fundamental analysis and you find there's some value, and then you see this, it becomes more reassuring that, well, that the company also feels that this is a good value. So the next, we'll have 4 charts for you, and this is from Y Charts. So some examples to see what has happened in the past. So like, let's say NVIDIA. NVIDIA on October 31st, they had a buyback of 3.48 billion. And you see on July 31st, there was another 3.34 billion. April 30th, 2022, they had almost 2 billion. So the maximum that they, in the past 5 years, that they wanted to buy back was it was $3.48 billion of their shares to buy back. The median was 427 million. So some of the buyback stocks in the similar industry, advanced micro devices, is Intel, Marvell, Micron, Texas Instruments. You see the numbers, for instance, Texas is 798 million. So now we look back and we see, well, in October, they announced that, and this is around this time, they had the 3.4 billion. But then, there are times like in July, it was a little higher. So, but that's the coincidence. Again, that's what I want to follow. You can see Microsoft does that quite a bit. You can see that December 31st, 2022, they had $5.21 billion. Before that, on September 30th, it's like on every quarter, they have a 5 billion, 5.2 billion, March 31st, another end of quarter. So they have quite a bit of buybacks. They also pay dividends. So you see that the maximum was in March of 2022 was at 8.34 billion. And since then, it has been a little less and less. And again, comparing to the other companies, you can see it yourself. So when we go back to, again, that's a quarterly, so they have a systematic, but they are not, they haven't, the timing sometimes is not the best. So the other one is famous for is Apple. You see Apple actually had 19.4 billion. They also, you see the quarterly, every quarter they are doing systematic. And then the maximum was December of 2020. They put down to buy back 24.78 billion. Remember, again, we're looking at the cash flow and how much cash on hand they've had. Again, with the low interest rates, and then you see compared to Cisco and Intel and Micron and NVIDIA. And this is their chart as of today. And the last but not least, in a complete different industry, we look at the oil industry and energy stocks, and this is ExxonMobil. Now, they just announced on December 31st, they're going to buy back 4.67 billion. And that's the highest they've had in the past 5 years. And then you see the Diamondback and Devon and Occidental also buying back their shares. And obviously you can see the movement in Exxon. So, the last part I want to share with you is, let's say you like the strategy and you are looking at some of the companies, but you think, is there an easier way? And of course, with the presence of ETFs, that made our lives a lot easier. So there are 2 main ETFs that you could use. Both are with Invesco. One is, the most famous one is the Invesco Buyback Achiever, and that's PKW. And as you can see, they've been around since December of 2006. So this focuses on the stocks or the companies that it had repurchased at least 5% of its outstanding shares in the past 12 months. So they think that because of that, they will be, again, we talked about the ratios and the affecting the balance sheet and also their income. Basically, that allows the EPS to increase, so they look favorable. And they are the list of the 15 biggest holdings that they have, such as Comcast, Morgan Stanley, ConocoPhillips, Amgen, Lowe's, Booking Holding, Cigna. So these are the 15 largest, and this is their, their chart. You see year to date, they're up about 5.84%. They pay about 1.34% in dividends, which is interesting. Again, these companies, some of them are, most of them are growth, some of them are mature and they pay dividends. And so basically for the performance for year over year, they're only down 1.3%. So this is a little conservative strategy if you like to be in the market, but you don't want to, you want to make sure there's some value. The partner of them, they came out with 2014, that's Invesco International Buyback Achievers. Now, international companies are a little more rigid than United States, so they have a little more regulations, which is they look at the management a little more carefully. But it is the same thing. The Invesco International Buyback looks at the non-US companies that they bought, again, the same thing, in 5% in the past 12 months. The companies must have minimum market capitalization of at least 250 million. And they also have the daily trading threshold, so they should be more liquid. And you see NatWest. NatWest is the #1 holding, and you have Suncor, for instance, and Vail, and Roche, and WPP. So there's quite a few companies out there. And this is their chart, and they're up about 5.98, almost 6%. Year over year, they're down 10%. But it's interesting, they pay very high dividends, and almost 10%. So we have to dig a little deeper whether there was a special capital one-time dividend payment or not. I don't know, but it's pretty big dividend. They don't have options. PKW does have, let's go back. You see the PKW is more liquid, and they do have options on them. The average volume is about 287,000, but there's no consistency. So you see the volume kind of dries out. So there's always in the special times that the volume goes up. So got to be careful with that. And the same thing with the international, the average volume is only 19,000. So, but again, that's one of the ways, if you like to participate, that would be an alternative. So with that in mind, I hope it was informative. I hope that there was something that you could take advantage of. And with that in mind, I'm gonna stop the recording, and then we open up for Q&A. Thanks.